if the trade fails, risking a large portion, if not all, of their trading capital. Lastly, ignoring market signals that contradict a trader's position is another common mistake induced by optimism bias. Traders might disregard essential market trends, news events, or economic indicators if these signals suggest their trade might fail. Ignoring such signals means traders miss out on crucial information that should prompt a reassessment of their trade. In summary, optimism bias in futures trading can lead to severe lack of proper risk management, exposing traders to outside losses. The key to overcoming this is maintaining a balanced perspective on trading, treating wins and losses with equal importance, and strictly adhering to risk management rules. Traders in the community, how have you kept your optimism bias in check? Do you have specific risk management strategies that have worked for you? Your insight could help guide others navigating through the challenging waters of futures trading. Loss aversion. Talk about the common tendency among traders to hold on to losing positions for too long in hopes that they will turn around. A phenomenon known as loss aversion. Loss aversion, the costly trap in futures trading. In the realm of futures trading, one psychological pitfall tends to ensnare even the most experienced traders: loss aversion. It is the human tendency to strongly prefer avoiding losses to acquiring equivalent gains. In other words, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Applied to trading, this can lead to holding on to losing positions for too long, hoping they'll turn around. Every futures contract involves a buyer and a seller, both speculating on the direction of the market. The buyer is betting the price will rise, the seller that it will fall. Yet, when the market goes against their prediction, many traders hesitate to admit the misjudgment, holding onto the losing position longer than they should. This is loss aversion in action. The loss aversion trap is particularly pronounced in the futures market, given its high degree of leverage and potential for significant swings in value. A small price movement against a position can result in substantial losses. Influenced by loss aversion, a trader may continue to hold onto the position, hoping the market will reverse direction. This tendency to ride out losses often leads to catastrophic results as small losses snowball into significant financial damage. To avoid falling into the loss aversion trap, successful traders often set predetermined exit points for their trades. If a trade hits this stop loss level, they will close the position, accepting the loss as a part of their trading strategy. They understand that not all trades will be winners and that minimizing losses is just as crucial as securing profits in successful trading. In addition, traders can use hedging strategies to protect against potential losses. By taking the opposite position in a related assets, they can offset some of the losses if the markets move against them. How about you, fellow traders? Have you ever found yourself caught in the grip of loss aversion? How do you break free? What strategies do you employ to ensure you do not fall prey to this common pitfall called loss aversion? Explain how this emotional bias can lead to significant losses and erode a trader's capital. Emotional bias in futures trading, a slippery slope to significant losses. Emotional bias in futures trading, a slippery slope to significant losses. Emotions and trading can be a volatile mix. This is especially true when it comes to the world of futures trading, where the stakes are often high and the markets move swiftly. One of the most potent emotional bias that traders grapple with is loss aversion, and it can prove to be a slippery slope leading to significant losses and the quick erosion of a trader's capital. Loss aversion, a cognitive bias where the fear of loss is more potent than the potential gain, can compel traders to hold on to losing positions for far too long in hopes that the market will rebound. This is rarely the case, and if the market does rebound, it's a bad habit to build, and we want to develop good trading habits and not ingrain bad trading habits. This emotional bias often overrides rational decision making and leads to poor trade management, which we are trying to avoid as futures traders. Consider the scenario: a trader takes a long position on a futures contract, expecting the underlying asset's price to rise. However, the market turns and the price begins to drop. Despite the adverse market movement, the trader, influenced by loss aversion, decides to hold on to the position, hoping the price will bounce back. This decision, driven by fear and hope rather than strategic reasoning, can lead to significant financial loss. The market may continue to move in the wrong direction for the trader, resulting in the trader's position losing more and more value. As the trader waits for a turnaround that may never come, the losses mount, rapidly eroding the trader's capital. In contrast, a trader who is not swayed by emotional bias would have predetermined a stop loss in place. The strategy automatically exits the trade at a certain loss level, thus limiting financial damage. The futures market, with its inherent volatility and potential for high leverage, can amplify the impact of loss aversion. Traders can see their capital base significantly reduced or even wiped out due to a series of ill-judged, emotionally influenced Traders can see their capital base significantly reduced or even wiped out due to a series of ill-judged, emotionally influenced decisions. Have you ever found your emotions dictating your trading decisions? Can you recall an instance where emotional bias lead to a poor trading outcome? Share your experience and lessons that you've learned. Remember, it is through shared experiences and discussion like these that we're able to become better traders. Discuss how some traders become overconfident after a series of successful trades, leading them to take bigger risks and ignoring warning signs. Overconfidence in futures trading, a risky road to ruin. One of the most tantalizing and dangerous emotions a futures trader can experience is overconfidence. This inflated sense of one's trading prowess usually surfaces after a string of successful trades, as the triumphant trader begins to feel invincible, leading them down a risky road that could potentially lead to significant losses. Overconfidence can turn a prudent trader into a reckless one. With each successful trade, the overconfident trader starts to credit their success solely on their skill and strategy, ignoring the role of luck, market conditions, or other external factors. They might start to believe that they've cracked the code of the futures market, convincing themselves that they can accurately predict market movements. This illusion of control can prompt traders to take bigger risks. They might start placing larger trades using excessive leverage. In a sense, overconfidence can make traders feel bulletproof, blinding them to the very real and inherent risks of the futures market. Moreover, an overconfident trader may start to disregard warning signs of market signals that goes against their positions. They might ignore stop-loss orders or hold on to losing positions, believing the market will inevitably turn in their favor. This can lead to a poor trade management and significant financial losses. Overconfidence can be particularly disastrous in the futures market, given the market's volatility and the potential for leveraged trades. An overconfident trader can quickly find themselves facing steep losses. It is a harsh reminder that no matter how successful a trader might be, the market always has the final say. Can you recall a time when overconfidence led you to take on more risk than you should have? How did you recognize